Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. President Donald Trump is set to roll out the most expansive US trade restrictions in a century, as the president's team is said to be still finalizing details of the so-called reciprocal tariffs. US and European futures edge lower as equities traders remain cautious ahead of the announcement. Copper and gold trade higher. Plus, Mercedes weighs pulling its cheapest cars from the US market as automakers make last-ditch attempts to sway the US administration.
In the meantime, a quick check on these markets. You mentioned that futures are lower, but take a look at the margin by which they're lower. The volatility of the last 48 hours not necessarily reflected to the same extent in the futures picture, both down about 0.4% on Stoxx 50 futures and the FTSE 100. Some movement in the FX space, though. This is where you want to keep your eye because the dollar is stronger today, 107 on euro dollar. But the Japanese yen has been having a moment. Goldman saying that's the hedge to keep an eye on. The countdown to the opening trade starts right now.
Wednesday the 2nd. Welcome to Wednesday the 2nd. I'm going to call it Clarity Day. I say that with a little pinch of salt. Are we really going to get clarity? And will the market reaction reflect the clarity that we get? Are we going to stay up?
That's a question, isn't it? I mean, maybe that's a niche question for this group because we get up very early. But there'll be lots of people, depending on where you are in the world, I suppose, wondering whether you will be there in the live moment to watch this.
It's like waking up on Christmas morning, the following day, Thursday morning, all the kind of things that you've been expecting and looking for.
For news junkies, perhaps. Let's talk about what we know and don't know, and there's a lot in the second category. So either this is all settled, which is what President Trump told us, or it's still being finalised, which is what his team seems to be saying. So it does seem as if this is still going down to the wire, lots of options still being discussed. So a few of them that have stood out in our reporting. We've been talking for a long time about the possibility of bespoke, tailored tariffs, one country versus another country. That is still in the mix. There is also this other idea that maybe you get a tiered approach where all countries are either on a 10% tariff or a 15% tariff, depending on whether they're big offenders in the eyes of the Trump administration, or do you go with a flat global tariff? And apparently that is still in the mix. And so there are a range of options. We don't know. These are the things that are still being discussed in Washington.
The new bit is the we're not going to go for the kind of single approach. We're going to go for a tiered approach. Does that mean that, for instance, the EU could be hit with 25%? Maybe it is higher than 10-15%, and the UK gets 15%. That would be an interesting kind of narrative for Europe to manage, I think, and the optics of that, I think, will be fascinating to see how the various media organisations across the continent will deal with that tomorrow morning as we all wake up to this amazing news.
To Christmas morning coming 9 months early.
The clarity morning. Let's call it clarity morning.
I like that you've taken control of the narrative and renamed it. I think it's crucial as well, though, is that this is only the country tariffs. We're still expecting sectoral tariffs as well, so that's the other piece of this equation as well. But historically, he's gone for this kind of blanket tariff in terms of a specific country. So it hasn't been like a country first, then sectoral. So I'm using this as an example from the first administration. And he's done it in response to things like quotas, for example, that you have to fulfill, or barriers that have to be removed that haven't actually come to fruition. So when I'm thinking about this, I'm using the kind of U.S.-China trade map from his first administration as, are we going to see a repeat of that? The concern here, though, is that this doesn't account for sectoral tariffs. So I don't know how you price that in.
And we've already got some, haven't we? Well, it's not delivered yet, but it's been announced, the autos one, for example, steel and aluminium. A couple of other nuggets that stood out to me on this, as we're waiting for the tariff announcements. Scott Bessent was saying that these are a cap. This is as high as it goes. And that sounds in contrast to some of the way we've seen Trump behave in previous iterations of this, against Canada, for example, where he said if you behave in a certain way, these tariffs go higher. So are these really a cap is an interesting one to explore.
Who do you think we listen to here?
Well, yes, that's interesting. And when do they take effect? We heard yesterday immediate effect. So this time tomorrow, will we be pulling up that function on the Bloomberg terminal with all those ships on it that says, that shows us ships that were setting off for New York or setting off for America that turn around and go somewhere else because their cargo is not going to be delivered there anymore?
I think the market reaction is going to be interesting. You were bringing up the yen. I think that's a fascinating story. Euro-dollar. So I'm going to watch euro-dollar. This is going to be my barometer overnight. When I wake up first thing tomorrow morning, we're going to check euro-dollar. If euro-dollar is higher, does that signal that the market believes that the US is going to be worse off as a result of this? It's going to be really interesting to see how that narrative is spun by the markets. Who suffers the most here? Which economy will get hit hardest? And the economic data's already beginning to show up some hits to the United States. Look at what came out of the ISM data yesterday. Clearly, there is evidence of a slowdown within that. There's clearly some tariff front-running within that as well, some pull forward. So it's going to be... I'm looking for signals in terms of which asset classes we're going to be watching. I think euro-dollar could be one of those.
The inventory pull forward is so important here because we're waiting for that market reaction. We're waiting for the ships to turn around, et cetera. But I wonder if they already did 2 months ago in anticipation of all of this, because to your point, it showed up in the ISM data, it showed up in the PPI data. It's likely to show up in other spots as well as we get more and more information. But I think the margin of this data was really important as well because the ISM showed a recession-like threshold. This is only something we've talked about in the markets. It hasn't shown up in the data yet in terms of comparing it to previous recessions. But that's where we're at.
Yeah, I'm looking at the high-yield market and credit and wondering where that one goes. We're going to have a conversation perhaps with Simon White a little bit later in the programme about this. But that could be an area to watch as well as supply chains become under stress in a way that we cannot at this point predict. Where are we going to see those pain points? And is it going to be in high yield, where we've seen some adjustment to recession expectations, but not a huge amount? And if you look at those spreads, they're still near decade lows. So that is giving some people
Did you see the prices paid, though, within the ISM?
Yeah.
It's in the 60s.
Yeah,
This is inflation. So how does the Fed manage that? I think will be also interesting. Car prices look like they're going to be going higher in the United States. You've already seen an indication maybe that Mercedes is going to be pulling some of its lower margin vehicles out of that market. It just doesn't make economic sense. That's a story that is certainly doing the rounds. Tariffs start to get collected on the 3rd. So tomorrow morning we will start seeing auto tariffs being collected as well. We've had a sort of a slow warm up into this story relative to others as well. But you are going to start seeing those tariffs coming in. You are likely to see a significant price rise in terms of car sales in the United States. What you have seen in terms of the car data that we've just got is an indication that actually the early months of this year have seen a big splurge in the United States. Americans have been out buying cars because they're clearly worried that they are going to be hit further down the road. So Hyundai has done very well, GM's done very well. Tesla maybe not. We'll find out later. Yeah,
it's interesting that some of the other car makers, the upper-end ones, the Aston Martins, the Ferraris, the ones that are going to be really worried about these tariffs, they've been talking in recent days about putting up prices. So Ferrari's saying they'll increase them by 10%. Maybe the tariff's going to be more than that, though, so that suggests that there's pain to be felt elsewhere in the supply chain as well.
Well, I think it's interesting as well because if the whole point of this is to buy American, if the whole idea is to create market share for GM, Ford, arguably even Tesla, Mercedes pulling the entry-level vehicle is a really great way to do it. So from a kind of market share gaining perspective, whether or not that actually comes to fruition is a different story because not only does Mercedes have to pull the entry-level vehicle, but GM and Ford have to make up the difference, and then they can't do that.
And then it collects less tariff revenue. And so that takes us back to what we were discussing yesterday about what is the end goal. Is it to collect the tariff revenue or is it to restructure manufacturing within the United States?
Bank of America thinks that car sales could be down by 20% in America. So yeah, maybe we will see Americans buying more American cars, but they'll be just buying fewer of them.
Yeah.
So in terms of the total mix, maybe there's a few more Americans in there, but the total market could be significantly smaller.
Let us keep track of all the conversations that are going to be coming quickly to our screens today. We'll be speaking to the US Commerce Secretary Howard Lutnick on President Trump's tariff announcements. That interview is at 1:30 p.m. UK time, which is just fascinating timing because that is many hours before the announcement. But he clearly feels he's got the freedom to say things, so we will be interested to see what he has to say.
How useful it will be, I don't know. We're all going to tune in, but we'll wonder whether or not actually what he is saying is what the president is ultimately going to say. Let's talk about what we've got coming up on the show, because we've got some great guests to talk about all of this. Ignacio Garcia Becerra, the EU's former chief trade negotiator, will be joining us. We'll get his take on how the EU is going to respond. Helen Jewell, BlackRock's CIO for Fundamental Equities, EMEA, is going to be joining us. Pretty positive on European equities going forwards. Max Layton, Citi Global Head of Commodities Research, is going to be joining us as well. Yes, we're going to be talking about gold. And Myron Brilliant, former head of international affairs at the US Chamber of Commerce, is going to be joining us as well. Really interesting things to say about what the China relationship is likely to look like going forward from here with the tariffs kicking in.
A lot of really fascinating conversations. I think we've got every angle covered over the next 2 hours. Plenty of data to look ahead to as well. Of course, leading up to that big tariff announcement later today at 12 p.m. UK time, U.S. MBA mortgage applications are worth keeping an eye on. Now, usually we don't keep an eye on this data, but I think it is worth it this time. If there's a concern about a recession, if there's a concern about delinquencies on auto loans, for example, it may just show up in these kind of micro pieces of data that we traditionally don't trade on, but this time may be the exception. We're, of course, looking down to payrolls on Friday as well. The U.S. ADP numbers at 1:15 p.m. UK time may be something that either reassures or spooks the market. Keep an eye on that one. 3 p.m. UK time, U.S. factory orders as well. Do we get those early indications of the kind of pull forward we were just talking about? And then, of course, the big event, 9 p.m., Trump's reciprocal
Just not sure the markets know what to do with all the data at the moment, because your point is important about the prices paid component of ISM. But at the same time as that, I was seeing some people dismissing the ISM overall number and the weakness that we'd seen there by saying, oh, don't worry, the Fed's going to cut rates. Well, if you're worried about prices going higher, then how can you come to that conclusion? So it seems as if all of the data is finding it hard to land and for us to make sense of.
I think everything is confusing. There's not a lot of clarity yet, which is why it's going to be Clarity Wednesday. And we're going to get some a little bit later on.
You should trademark that.
What else are we going to know? What else do you need to know this Wednesday morning? Marine Le Pen's hopes of running in the 2027 French presidency have been given a boost. This after the Paris Court of Appeals said it should be able to rule on a challenge to her election ban by the summer of next year. That's much sooner than expected, and the far-right leader, remember, was found guilty of embezzlement on Monday and immediately banned from running for office for 5 years. The US Secretary of Defense, Pete Hegseth, has ordered an additional carrier strike group to head to the Middle East. He has also ordered the Harry S. Truman aircraft carrier group to remain on station for an additional month. Last week, the US deployed B-2 stealth bombers to Diego Garcia. The huge deployment comes as tensions with Tehran are increasing over its nuclear program, and the US continues to strike against Iran-backed Houthi rebels in Yemen. And a Democratic-supported candidate beat her Elon Musk-backed rival in a closely contested race for Wisconsin's Supreme Court. Circuit Court Judge Susan Crawford won out against the former state attorney general, Brad Stitzmul, can't see that one, in one of the most expensive judicial contests in U.S. history.
Today, Wisconsinites fended off an unprecedented attack on our democracy, and Wisconsins stood up and said loudly that justice does not have a price. Our courts are not for sale.
So, Crawford's win will preserve a Liberal majority on the state's Supreme Court and could have impacts on abortion rights, labour laws and congressional redistricting plans. Despite the loss in Wisconsin, Republicans held onto 2 House seats in Florida, winning about 57% of the vote in both districts, but by smaller margins than in the November election. Pushback begins.
The pushback begins, I think, for an international audience. A lot of people are asking, is this the beginning of the end of this kind of rise in Elon Musk and kind of the MAGA movement that we've seen? And the answer is not yet. This is not kind of that canary in the coal mine moment, because elections like these are usually low turnout. They're usually kind of influenced by very motivated voters. They're not necessarily an indication of the larger turnaround that we would see.
Yeah, I was listening to campaigners on the trail yesterday saying they were persuading people to get out, trying to convince them that this was more than the usual and that it had wider significance. I mean, that's one way we're looking for the impact of Elon Musk on politics. Meanwhile, he, of course, has a day job to do, which is running Tesla. He has many day jobs to do, which is running Tesla is one of them. And we're going to get Tesla sales due out later. And there we could see another indication of whether, just how troubled the sales picture has become for that business, not just in Europe, which is a well-known story, but elsewhere.
I think the last month data we saw from Wards, which tracks these things in the United States, is that EV sales are up 19%. I think that's a year-to-date number, but I could be wrong about that. I probably need to double-check. If we're up by 19% and Tesla is down, that is not good news.
Yeah,
that is a very bleak read.
Yeah.
And I was about to say, it's a very similar picture in Europe.
Certainly something we're going to be keeping an eye on in both the U.S. and, of course, the read-through into the rest of the world as well, or vice versa, by the way. Speaking of Europe, though, let's talk about some headlines crossing the Bloomberg terminal. This coming in the banking sector. Some banking consolidation, or lack thereof, that we are keeping our eye on. Credit Agricole is saying that the ECB has okayed its stake to raise in Banco BPM to the tune of 19.9%. Now, this is also significant because at about 6:55 a.m. this morning, UniCredit has also gotten approval from the Italian watchdog for its entire Banco BPM BPM takeover. So how this all shakes out in the market is going to be crucial. Feels like a war for Banco BPM between UniCredit and Credit Agricole.
Coming up on the programme, we'll take an in-depth look at how Washington's tariffs are already impacting the world's largest plane maker, Airbus, as well as its suppliers. Plus, haven assets are winners amid the global trade and growth uncertainty. Gold is near its record, while Goldman Sachs picks the yen as its preferred hedge. We'll have more on the markets. Up next, the focus is on bonds. We'll be speaking to Rufaro Chiriseri, who is UK head of fixed income at RBC Wealth Management. If you want to get involved in any of our conversations, IBD plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
I think Jay Powell at the March meeting, at least to me, signaled they're happy to basically sit on the sidelines. I don't see them acting preemptively to cut rates because they may be worried about a downturn. And so what that means is that it will take tangible data of a slowdown in payrolls, maybe a big pop in unemployment. So I see the Fed on the sidelines until the macro data really turns.
Bit of clarity needed. Former Fed Vice Chair Rich Clarida speaking on Bloomberg TV yesterday. Everybody's trying to figure out what today's going to mean. I suspect the Fed is also trying to figure out what all this means. What is the tariff story going to mean for the US labour market? What's it going to mean for inflation? All of that in focus today. And Valerie's got some great charts to line us up.
Guy, good morning. I thought it was very interesting to see the positioning in the Treasury market. I was taking a look at the put-call skew, and we are heavily skewed toward calls, meaning that on this number today, on this announcement of the tariffs, the market is more concerned about a big rally in the Treasury market on growth concerns rather than a backup in yields on a potential inflationary impact. I think that's a good take-home today, that perhaps the first gut-put reaction in the markets is going to be one of a growth concern rather than the secondary, perhaps secondary inflationary impulse from these tariffs. There was also an interesting note out from Goldman talking about their favorite hedge when it comes to FX, and that is in the yen. They see the yen really outperforming, especially in an environment, Guy, where we see real yields headed lower and the U.S. equity market lower. They want to be in the yen today. Their year-end target is around 140. That's a 7% move stronger in the yen from these levels. But they also are noting that, hey, yes, tariffs are a big risk today, but don't take your eye off what's coming Friday. We have a big payroll report, and then after that, Fed Chair Powell is speaking. I want to echo what Richard Clarida said in that video just a few moments ago, that the Fed is looking for the hard data to show a weakening of the labor market, perhaps before they go and tell the market that they want to cut in the next few meetings. Perhaps it's a weak payroll print on Friday that could really be the macro catalyst of the week.
Well, it's interesting. I mean, tracking the whisper number all week, and it's been coming up. So we're now at 110. The survey numbers also pushed higher as well. We're now at 140. So the market's actually looking for more upside on that number. Valerie, thank you very much indeed. Rufaro Chiriseri joining us now, UK head of fixed income at RBC Wealth Management. Nice to see you.
See you too.
Can I hide out from the Trump tariff story in fixed income? And if so, how specific do I need to be? Is this my safe haven?
I think it really depends in terms of what your risk budget is. But I think ultimately we think treasuries have gone a bit too far in terms of the rally that we've seen in the market so far. When we look at sort of forward-looking inflation swaps 1 year out, we're starting to see that tracking higher. So certainly we're not seeing that inflation being priced into treasuries at the moment. Okay. So we're not seeing that as a particularly good trade at the moment. I think some of that growth story is feeding too much into that rally. But we certainly see the UK market presenting an opportunity, given that we're expecting the BOE to ease more than current market pricing.
What about the tariff story for the BOE and the ECB? If the UK gets a better deal than the Eurozone, do I favour gilts over Eurozone govies as well? How subtle does it need to be?
I think for the UK market, certainly the exposure in terms of, I suppose, the trade surplus that the UK runs with the US is much smaller than the EU. So the UK is less so in a fiery line in that sense. But we think ultimately the output story for the UK is looking less favourable in comparison to the EU. So we certainly see that the BOE could be easing sort of about 3 times this year. in comparison to what the market's currently pricing in, only 2 cuts. Yeah. So we certainly think gilts potentially have a place to sort of have, I suppose, some decent returns in the near term. But of course, they remain quite sensitive to that fiscal story because we do have a very small headroom from the latest spring budget.
Yeah. Yes. Let me talk about the sort of the US side of things and maybe what that does to the global picture then, Rufaro. As you were just discussing there with Guy, what's going on with yields, really fascinating in the United States and Treasuries. How are you thinking about the time horizon for the impacts here? So if in the immediate moment markets seem more worried about growth and not inflation, it's possible for them to worry about both things, but over different time horizons, I suppose. So is it we worry growth now, inflation 1-2 years down the track? Is that how we think about it?
I'd certainly say the market needs to be thinking about the inflation aspect, I suppose, in the near term, because that certainly is a risk within the market. But I think ultimately the softer data has been trending more negatively, and that's really what's been driving the US bond market at the moment. We're yet to see the hard data really sort of come up to where the soft data is. And so we think the market has perhaps gone a little too far in that sense.
Yeah, we used to obsess a lot about policy divergence in different geographies. You know, the Fed doing one thing and the ECB and the Bank of England doing another. And it seemed as if they all had to tack broadly to the same path. That just doesn't feel like the place we are right now. I haven't had a conversation about that for a long time. Do we not worry about that then, Rufaro, now?
Well, I suppose the key thing is we are seeing, I'll certainly say for the BOE, that's possibly the central bank that might surprise to the dovish side, just because of what's currently priced in at the moment. I think that inflation story still continues to be an issue in the UK, but we don't think it's really going to play out as aggressively as the BOE has forecast. We certainly think that wage inflation will come down, and we have seen CFO surveys sort of pointing to wage inflation trending downwards. That should prove to be positive for inflation. So we actually think the surprise might be for the UK.
Rufaro, do deficits matter anymore for the bond market?
Deficits certainly do matter, but I think ultimately, as long as there's a buyer for these bonds, I think the market is not too concerned. We haven't really seen, I suppose, even when we look at the UK and we look at other markets, we continue to see that demand for bonds continues to be robust. And of course, the UK also skewing their debt to be more shorter dated in nature actually means that, at least for demand, that should hopefully be somewhat positive as well.
You're kind of referencing this digestibility question, arguably this like liquidity question as well. This has come up in the context of French politics. What would the concern lie there? What would be the red flag for you when looking at the issuance?
In France in particular?
And anywhere.
I think the key thing would be if we start to see, say, through auctions, that we start to see that trades have a pretty long tail. Or that essentially, you know, investors are not as happy to pick up some of this debt, then it starts to be a concern. But as long as we continue to see auctions going down pretty well, then we're not too concerned. We're certainly not at the levels that we're seeing, I guess, during the gilt stress market when we had a pretty long tail in 30-year gilts and such. So we're not too worried at the present moment.
All right. Rufaro Krishgeri, UK head of fixed income over at RBC Wealth Management, joining us around the table this morning. We thank you so much. Guys, I bring up that question about France specifically because this is the kind of concern that's coming out of the blue that France is the second largest debt issuer in Europe after Italy. Yep. If there is a concern around Marine Le Pen or the stability there, that's where it would show up. It would show the issuance as opposed to, say, the traditional spread and trading.
Do you think that's coming out of the blue? I think the market's has shifted its stance on where France sits in the hierarchy of European government bond markets.
Absolutely, something that we're going to digest and also kind of counterbalance with the tariff story. We're going to dive into those details next ahead of that announcement tonight. That conversation next. This is Bloomberg.
Welcome back. It is Wednesday, the 2nd of April. We are going to hear a lot more about tariffs later on today. We'll have to wait till much later in the European day to get that. But in the meantime, the European equity market futures picture looks like this. Looks as if we will go a little weaker at the start of trade. The US session yesterday was really whipsawed. Actually ended up in positive territory, which is interesting given that we are expecting to go a little weaker at the start of trade here. A lot of nervousness about what these tariffs might mean then for Europe. Let's have a look at bond markets. Bond markets globally, it does seem as if, certainly from the Treasury's messaging, seems to be that the markets are more worried about the growth story rather than inflation right now. And we've seen a lot of people going into bond markets with that in mind. Today looks a little different to that, but really a bit of a holding pattern perhaps as we wait and wait for, well, will it be clarity day when it comes to the tariffs picture, or is this just the start of a lot of complex dialogues, Critty?
I guess we're calling it that now, Clarity Day. Look at the Guy Johnson effect happening already. Speaking of European...
There's some irony, obviously, in this.
I will say it with a wagon of sarcasm, as I do. European leaders, in the meantime, promising a strong plan to retaliate against Donald Trump's so-called reciprocal tariffs. Now, the European Commission's president says the EU is still aiming for a negotiated solution.
So many Europeans feel utterly disheartened by the announcement from the United States. Let me be clear. Europe did not start this confrontation. We think it is wrong. But my message to you today is that we have everything we need to protect our people and our prosperity.
Bloomberg sources saying officials are considering legal measures as well. Bloomberg's Oliver Crook joins us from Brussels to break it all down. Ollie, walk us through the levers that can be pulled here.
So listen, you have the sort of basic competencies of the EU, which is really focused on trade, and that is where we've seen in the past sort of retaliation from the Europeans towards some of the aggressive, trade action that we've seen from the United States. As we've heard from the very beginning, this is not the solution that the EU would like to pursue. They'd like to have a negotiated solution, but they are saying that basically if it comes down to it, they're willing to act strongly. There is more and more talk about this idea, this anti-coercion legislation that exists within Europe that really allows not just sort of trade action, but also actions on intellectual property, sort of restrictions on direct investment, all of these sorts of things. We understand that the French have been pushing to basically put this on the table. We should say that that action has never once been deployed in the past, and it would potentially be sort of an escalation in this sort of trade war, one that perhaps the EU does not want to pursue. But again, it is going to come down to what we get today. Everyone knows what it's called, Liberation Day. No one knows sort of what's inside of it, and that is going to be sort of when the calculating starts, not just from the sort of European policymaker standpoint, but also from the corporate standpoint tonight in order to sort of calibrate the correct response. And we should say that part of that calibration, obviously this is all to do with sort of domestic economic policy with the United States. This is also foreign policy. And we should say that Marco Rubio, the Secretary of State of the United States, will land in Brussels basically hours after these tariffs come into play to have a NATO meeting. And this is another part of the calculation. The Europeans need the United States on board on the question of defense, on the question of Ukraine. So again, it's a very sort of narrow line to walk, but we should say the Europeans do have at least a fairly large chip in these discussions. There's a $1 trillion trading relationship on the line. That being said, there is a trading surplus for the Europeans that will be more vulnerable of about $200 billion. And so all of these sort of equations come, all these sort of inputs come into the equation as we get that announcement about 10 p.m. Brussels time.
Ollie, that's the government response that we're talking about there. What about the corporate response?
So what's really interesting here is when I spoke to the BMW CEO just a couple of weeks ago, they were talking about the impact of the tariffs of just Canada and Mexico on BMW's operations, because they build some of their cars in Mexico. They said that would cost them €1 billion. That is a drop in the bucket compared to the potential, what we should say, the 25% tariffs that the U.S. administration is talking about imposing. And we should say that BMW creates a lot of cars, yes, in Europe and ships them to the United States. They build a lot of cars in the United States and ship them back to Europe. So if you get into a position where then the Europeans retaliate and put tariff barriers there, they get hit in both directions. And we're hearing the same thing from Mercedes-Benz overnight, where we've had sort of reporting overnight that basically their entry-level vehicles, entry-level SUVs, may no longer be viable to sell in the United States. And again, these are all part of the corporate sort of calculations that will begin overnight. And I will say this will be a very interesting earnings season, because these companies need to calculate not just what the impact is going to be directly on their operations, but what it's going to be on the sort of macro picture and consumer demand more broadly. That's going to be basically, I think, a black box, certainly until tomorrow and probably for months to come.
Oliver, thank you. Bloomberg's Oliver Crook with the latest on what we are expecting when it comes to these trade tariffs. Let's bring into the conversation Ignacio Garcia-Botero, who is a non-resident fellow at Bruegel and was the EU's chief negotiator for a now-abandoned free trade deal. We remember it, TTIP, the Transatlantic Trade and Investment Partnership. Ignacio, thank you so much for joining us. Really good to get your perspective. We were just hearing there from our colleague Ollie about the various levers that the EU could pull here, and they have a new one. This new one that's been introduced since President Trump's first administration, and that is ACI, the anti-coercive instrument. Is that where we focus? Is that what the Europeans should focus on in terms of their retaliatory approach?
Good morning, and thanks a lot for having me here. My sense is that there's going to be a combination of instruments and a combination of approaches. Now, it's important to bear in mind that we are not only facing the new announcement that will be made later today with the so-called reciprocal tariffs. We also have the tariff on steel and aluminium, on which the European Union has already announced a retaliation list about 2.6 billion. And this will come into force around the 15th of April. There's still some final adjustments that will need to be done on the list. There have also been already the announcement that I think the 12th of April, 25% tariff would apply on cars and car parts. That's a hugely important export for the European Union. No announcement has yet been made about the retaliation list, but I'm sure that that is prepared and probably will be made public very, very, very soon. Both of these actions do not require the invocation of the anti-coercion instrument. They can be done on the basis of a different legal tool that the European Union has available. But it is likely, depending on what it is announced later today, that if the tariffs which are announced by the US are coercive in nature, are basically taken with a view to get the European Union and its member states to change its policies on taxation, to change its policies on regulatory matters. That is the purpose of the tariffs. I think it is very likely that the anti-coercion instrument would be invoked for the first time. It's a relatively new legislation. It has not been used so far. But I think if we are faced with hugely damaging coercive action, I think the European Union will have no other option but to also trigger the anti-coercion instrument.
Okay, so just so I'm clear, if this is all about VAT, if it ends up being mostly about VAT, then that's the path that Europe takes in ASEO.
Well, if it is about VAT, if it's about the European Union regulation, if it's about complaining about the level of European Union tariffs, which are basically fully consistent with our WTO commitments, if the purpose of this action is to basically put pressure on the European Union to change its legitimate policies, that's coercion. I mean, if you look into the definition of coercion and the anti-coercion instrument, that's precisely what coercion is. And we are not talking about something minor. We are talking about something that can have a major impact on the European Union economy. I'm sure that Commissioner President von der Leyen has been discussing this issue at the highest level with the member states. There will also be a meeting of trade ministers the 7th of April. So my impression is that this is what happens later today. The invocation of the anti-coercion instrument is quite likely.
Ignacio, there's been a question about what the red line is for Europe when it comes to things like targeting services or targeting technology, for example. And guests on the show have said that that is the Hail Mary. That is the last kind of barrier for the European Union. What would, in your opinion, the United States have to do for the European to respond using things like financial services and tech as a tool?
Well, you know, if what the United States is going to do is going to be to apply, let's say, a 20% tariff across the board to most of all exports from the European Union to the United States, this is a huge economically aggressive action. The European Union is never going to be replying to this by applying 25% tariff to all the American exports into Europe. That would be an act of self-damage. We would, of course, be applying the 25% tariff, but on a more selective basis on areas where the political impact on the U.S. would be big and the economic impact on the European Union would be small. But that would also imply, in my view, looking into other areas of retaliation. There is public procurement. There could be, for instance, the option of excluding from European procurement bids bids which have a high level of American content. There could be some targeted action on the services. Yes, it is more difficult to design, but I think that probably colleagues in Brussels have been looking into possible options also to retaliate on services. I mean, all of this, of course, depends very much on what it is that the United States announces later today.
Ignacio, good morning. It's Guy. If the UK gets a better deal than the EU, how will that complicate relations between the two?
Well, let me put it this way. It is understandable that the UK is discussing to see how it can get as good treatment as possible when it comes to the tariff. What I think is going to be important is that the UK does not take any commitments that interferes with the reset between the EU and the UK in terms of their trade relationship. But I'm sure that this is an issue on which the Estonian administration is conscious about, and they would avoid entering into that kind of commitment.
Ignacio, we're going to leave it there. Ignacio Garcia Becerro, non-resident fellow at Bruegel and former EU trade negotiator. Thank you very much indeed. Coming up, what are we going to be talking about? We're going to be talking about the stocks that you need to be watching into the market open. Grifols is certainly one that is on our list this morning. This after reports that Brookfield has restarted contact with the Spanish plasma company over a potential acquisition. That stock in focus this morning. This is Bloomberg. Wednesday the 2nd, good morning. Futures are negative on both sides of the Atlantic. Equities are expected to open lower here in Europe. I think we're going to be down by, let's call it circa 0.5%, judging by the board in front of you. That's what we are looking for. Over in the United States, we're a little less negative, but still negative. The market is looking for clarity. Everybody wants clarity. What are we going to get out of the White House? The Rose Garden, 4 p.m. Eastern, is the moment to watch out for. Criti, what are you watching this morning?
Well, how people are positioned ahead of that critical moment tonight. I think the last 24 hours are crucial when it comes to, I think, your favorite metric that you've mentioned this morning, which is, of course, what Eurodollar is doing. Take a look at the FX volatility here for Eurodollar, the overnight rate. You are now seeing it spike, and you've seen spikes before, but how to the highest going back to the election. And that's how nervous people are in terms of what the reciprocal tariffs might bring, especially on Europe. And this is going to be crucial because it comes across a backdrop, a fairly low volatility, not just in Eurodollar, but the things you're seeing in likes of the Mexican peso and likes of the Canadian dollar, because we just don't know. And the FX market has been relatively sanguine in terms of the moves that we've seen in the equity market, the bond market, etc. Does this all change when we do actually get more of an idea on the tariff front? Those terms of trade will be affected. That's going to affect some of this movement, and you can already see, Anna, from the get-go, people positioning for that moment.
OK, we'll certainly get into some of the FX moves and the thoughts of Simon White on this subject in a moment. Let's bring Simon in. Simon White, Bloomberg Markets live macro strategist. And Simon, I want to start with some of the data we had out yesterday, because in the break you were just suggesting that this is really closely watched and a really good sense of where we are on the US economy, as close to now as it's possible to be. So the ISM report yesterday, disappointing at the headline, and a lot of people focused on the inflation component of it as well. What did you take away from this data point?
Yeah, as you said, the headline number, slipped, just below 50 or around 50, but the details were the thing that were most important. So the underlying new orders to inventory component actually leads the headline index, and that fell quite precipitously. That fell to one of its lowest level in several years, and that's really tariff related. So inventory component rose in a big way because people are obviously pulling stuff forward. And we also saw the prices paid component rose sharply too. So the underlying details are not very good. And if you look at manufacturing overall, it's a very cyclical industry. So even though as a part of the economy it's quite small, because actually in an intermediate basis it's like a third of corporate revenues. It's a very important industry to focus on. So the fact that that's beginning to slow, even though the services is quite strong right now, but manufacturing tends to lead services. So you really want to keep a close eye on that. So right now it's consistent with a slowdown in the US, but there's nothing we can say as of yet that's going to be recessionary. But obviously if that keeps turning more negative and that feeds into services, then you have to get slightly more negative on the US economy.
Simon, one of the pieces that you wrote yesterday really caught my eye, and it's about what's happening with the basis trade. Financial crises rarely start where you think they're going to start. It's usually the unknown unknowns that cause the problems. How much of a known unknown is the basis trade?
It's a very nice way of putting it. It's a big known unknown, because the trade now is probably double the size of what it was in 2020. And 2020, if people can remember, the basis trade essentially blew up at the very start of the pandemic, and that kind of caused the Fed to take this unprecedented action. I mean, within several days, it had to buy like 4 trillion treasuries to try and salvage this trade. So it's potentially huge. And the difference now, as I say, is first of all, it's much bigger. And second of all, the dealers, the primary dealers, the ones who can basically, their first line shock absorbers to try and deal with this trade, their balance sheets are much more constrained. They've basically, because the Treasury has been issuing so much debt, their balance sheets are now much full of Treasuries, so they're much more congested. So it's going to be much more of a problem for them to kind of deal with this. And a paper came out last week from the Brookings Institution suggesting that the Fed essentially crosses the Rubicon and has a backstop for the basis trade. So, that would be quite a big change if the Fed directly backstops hedge funds, which is how it would look.
All right, Simon White, Bloomberg Markets Live macro strategist, bringing us up to date on what that basis trade could actually mean. We thank you so much. More analysis from him and the team at MLIV Go on your terminals. Go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Critty. So we're watching autos again ahead of the big tariff news today, and in particular we're watching Mercedes stock as the company says it's going to pull some of its cheaper models from the US as a consequence of these tariffs. Now we can see Mercedes stock actually pretty much indicative of the entire sector in terms of the downturn we've seen given the tariff worries. And then I've also got my eye on Continental. The company gave an update yesterday, the auto parts and tyre maker, guiding for lower volumes and also potentially softer margins. Again, a lot of commentary about the negative impact of these tariffs on autos, so keep an eye on that sector today. Then in terms of pharma, a couple of bits catching my eye. Firstly, for Novo Nordisk and obesity peers, Hims & Hers in the US says it's going to continue or resume selling some obesity drugs, actually expanding its offering, and that has actually been market moving for Novo in the past. Just a couple of months ago, it did move that stock. So keep an eye on that one. It was a weak day in general for US pharma. Yesterday we saw the biotech index dropping by almost 3% after the close of European trading. So that could potentially feed through into broader weakness in European pharma today. Then staying in pharma, we've got a bit of M&A news in Spain. Brookfield said to be potentially back in talks with Grifols over a takeover. That did collapse over the past year. Grifols has also had a bit of a short seller report on it, which has hit the stock. But those talks potentially resuming is going to boost that stock, according to traders this morning. Keep an eye on Grifols in Spain, down quite significantly over the past year. Then in terms of rating changes, Berenberg has got a load of new buy ratings on the drink stocks, AB InBev, Diageo and Pernod, just 3 of them. There are several out on that. And then over in the energy space, NG in France gets a buy at Jefferies, and Rathbones in UK asset management outperform at RBC. That one could be a little bit stronger in London this morning.
Joe, thank you very much. Our equities reporter, Joe Easton, with some of the stocks in focus. Well, I mean, the whole global trading picture is in focus today, isn't it? Because we're waiting to hear from the Rose Garden from President Trump later on today. I'm quite fascinated. We had an interesting piece out by John Authors this morning talking about ignoring the first market instinctive reaction. And this is going to come right up towards the end of the US trading day, isn't it? And possibly if things get delayed, some of the detail might come a little bit later than it. So that's worth keeping in mind. And what detail will there be? Will we need to spend time looking at detail, or will this all be a headline story?
Which markets are you going to look for as well in terms of that reaction and the nuance that's going to come through? Is it going to be stocks? Is it going to be single stocks? Is it going to be what happens in the fixed income trade? Will it be what happens in the foreign exchange trade? The dollar obviously is going to get caught up in all of this as well. And I think you may get different stories from different markets, depending on the way that the story and how the narrative unfolds. So I think it's going to be interesting to compare and contrast different markets and different reactions.
Well, this is why today's trading session is arguably more important than tomorrow's, simply because everyone's going to be positioning, maybe going more defensive, maybe going back to neutral in terms of positioning for whatever they may actually get. And this is why I think the dollar story is so crucial, because people who have traditionally been so long dollar, so bullish on American assets, have now completely pulled back that trade. You've seen that dollar dollar weakness push the euro higher, push the pound higher, even push the yen higher as well. Not necessarily because they're not confident the dollar is the longer-term trade, but because they're just going back to neutral.
Right. And I wonder what clarity is worth. We talked at the top of the programme about this being perhaps clarity day, although with a twinkle in our eyes because we're not expecting it to really be the end of the story. No. But if there is some clarity, is that worth anything, or is that just a knee-jerk market reaction? We look right through it.
What bits don't we know? So there's quite a bit we don't know coming out of the Trump administration, but we've got, I think there's an idea of kind of the
direction
various
of travel.
buckets that potentially we could be going in. How does the European Union respond? How does the UK respond? How does Japan respond? How does China respond? That is also the bit that we don't know at this point.
And that can set things apart in terms of the international the historical, comparisons, can't it? Because sometimes these things are triggered by some tariff action, some global downturns, are triggered by tariff action, but it's how other countries respond to them that can be really crucial.
The key piece that we don't know and that hasn't been touched yet by the Trump administration is the energy infrastructure. And the biggest market reaction we've seen in all of this kind of tit-for-tat trade negotiation talk, especially with Canada, has been the energy infrastructure story. So any signal that LNG exports or energy imports are under surveillance is going to be perhaps a little bit more market moving. We're going to dive into that and all the topics coming up in the next hour. It is the opening trade. We are about 5 minutes away. Futures pointing lower. People are nervous. Stick with us. This is Bloomberg.
Wednesday the 2nd, the day we've all been waiting for. Clarity is going to be given to us. The markets are going to be able to move on. That's the narrative that we're looking at. Of course it's not. We are in a period of huge uncertainty. And yesterday we saw markets oscillating, trying to figure out what to do. This morning we've got futures a little bit lower, but as you can see, choppy session yesterday. US markets rally initially. Europe follows them higher. We then chop around a bit. I'm not sure there's a particularly good clue coming out of the Tuesday session into the Wednesday session for where Europe ultimately goes today. So much ground to be covered, so much uncertainty to be resolved. We'll see later what actually is resolved. I don't know, Critty. It's going to be a fascinating day, but futures initially a little negative.
A little negative, kind of bracing for potential more choppiness, more bumpiness. I will mention, though, yesterday the markets rallied in a very, very big way in response to the sell-off on Monday. So this red on the screen, Anna, that you may be seeing, especially concentrated in the likes of the DAX, may simply be a response to the massive outperformance we saw in yesterday's session.
Yeah, absolutely. And despite the fact we saw that recovery then late in the day stateside, maybe that means little in today's fast-changing, tariff-induced context, Critty. And maybe, as you say, it just reflects that strength in Europe yesterday. A few individual names to keep an eye on, although this feels like a day where we'll be talking big picture a lot. Grifols is certainly one of those. Are reporting then that Brookfield has restarted its conversations about an acquisition there. We'll also keep the auto sector in focus. A number of news threads there. The lines out of Mercedes last night about lower-priced cars in the United States, maybe not selling those anymore. Credit Agricole in focus as well as the ECB has said OK to them increasing their stake in Banco BPM. But today, Guy, feels like a big picture day, even if that means we move nowhere very quickly.
Absolutely. Where we begin may not be where we end, and certainly this time tomorrow morning is going to be a fascinating story for us all to factor into our thinking. We don't know what tariffs are going to deliver. This morning, the FTSE 100 opens down by 0.2%. Stoxx 600 is down by 0.2%. Not sure really what this is telling us, to be brutally honest. We'll see how the CAC, the DAX, the SMI and the IBEX all open this morning. The expectation is we're going to see a slightly softer start to the day. Where we finish, I don't know. Where we start tomorrow morning, I definitely don't have a clue. But there you go. Slightly negative. What does the sector story tell us, Critty?
Well, when you look right off the bat, it is, of course, a broadly negative story, and that was indicated by the futures picture as well. When you look at the biggest index contributors to the downside, it's actually a lot of pharmaceutical stocks. I think this is interesting because pharma was actually gaining yesterday. I'm wondering how much of that nervousness has to do with the sectoral tariffs that are due to come right after the country or all-country kind of tariffs. So Sanofi, Novo Nordisk, AstraZeneca, even GSK are all taking a beating this morning. So when you look at the healthcare stocks, that is where you see quite a bit of pain. But when you look at green on the screen there, travel and leisure and media are doing well. But again, well with a wagon of salt. Not that well, marginally well, Anna.
Yes, indeed. I was just looking at where we are seeing that outperformance. Energy is one of those sectors, but that's not oil majors necessarily moving higher. The oil price is pretty flat, slightly negative this morning, but energy stocks do seem to be, well, is that a place to hide out? If you're worried about inflation, is that maybe a place to hide out? That seems to be the market's thinking from time to time, isn't it? I mean, Siemens Energy is the best performing stock in the mix there, up by 1.4%. Retail also an area of slight brightness, the likes of Inditex and Zalando. Maybe people will always need fast fashion, is the conclusion.
Oh, always. Fashion matters, as does skincare. These are the important things. Novo's down, Sanofi's down, to your point, Criti. Astra's down pretty hard. GSK is soft as well. The market is clearly worried. As you say, there was a rally yesterday, but the market is clearly undecided what to do with this story and is struggling to figure out what to do next. I think it's going to be... The sectoral story this morning or this evening could be fascinating. He's clearly talked already about Ireland. Ireland's done well, he says, but we want that trade back. We want that business back. It doesn't happen instantly, but that kind of points to the idea that he sees pharma as being important.
Absolutely, and when you look at the kind of bottom 50 performers in the bottom performers in the Stoxx here at 50, Sanofi, Novo, Bayer making an appearance there as well. So again, to your point, a very sectoral story. BNP is nestled in there as well, seeing quite a bit of volatility, down about 2%. It is your worst performer in the CAC 40. Our team actually just flagging here that they've now gotten a cut to reduce from a hold rating over at Kepler Cheuvreux. So perhaps that weighing on the market as well when we look at that particular stock. But again, nervousness in the market. You can see it across the board. Let's bring in an expert about how you play all of that nervousness. Helen Jewell, EMEA CIO for Fundamental Equities over at BlackRock, joins the program. Helen, pleasure to have you on the program, as always. Look, a lot of folks are nervous about what's coming on. You can see that. Sell-offs everywhere, and not perhaps the end of it. Is the way forward to take a step away from companies that have international supply chains? There's been a narrative in this market that Spain, Italy, the smaller companies that have less international exposure are your best move right now. Is that the way to be thinking about this?
Yeah, absolutely. And great to be here. What an interesting day to be on. But that is a very important way to think about this. There are two areas that we're very focused on at the moment. The first of those is where you have got the domestic exposure. And the second of those is the areas where maybe the valuations have been a little bit less fruity, shall we say, and there's opportunity within them as well. Banks, I know you've talked about, but banks is an area that has done incredibly well year to date, but we still do see real value in the banking sector. And there are other areas as well. Some of those defensive names, some of your Magnificent Six names have done very well year to date. And some of those, maybe with less of that international exposure, remain very interesting. And then the energy sector as well that Anna mentioned. That is an area where valuations remain pretty compelling. So they are the areas that I think are quite interesting, where the valuations perhaps are not quite as high as other areas of the market. The value part of the market, in Europe in particular, is doing very well at the moment.
So if you use history as a indication of how you should do it or play this forward, which famously in Wall Street you shouldn't, as in past performance, is not indicative of future results. But let's say you do. The last time we went around this kind of tariff story or even inflationary impact story, the market kind of gravitated towards a lot of the commodity names, a lot of the commodity sector, thinking that is where the inflationary impulse would show up. We're seeing small elements. I hesitate to put a narrative to that in today's trade, but given that you are seeing some of the consumer staples, some of the energy names higher, it makes me wonder if that's another place to hide out, away from traditionally defensive names that may have that valuation issue.
Yeah, no, it is. I think, and one of the other areas we should mention, of course, is gold, which through the 3,000, it's been phenomenal. But the challenge at the moment is there isn't anywhere to purely hide because of the huge uncertainty that is in the market at the moment. Now, the best thing that could happen this evening is for that uncertainty to disappear, for a very clear narrative of these are the level of the tariffs and there is no negotiation. That is not what people are expecting. That's not what the indications really are coming out of the US. It is very much the opposite, that the tariff level might start high but could be negotiated downwards. Now, the worrying thing about that from a market perspective is it just keeps that risk in the market and it kicks the risk can down the road. Because then even those places that you might be able to hide, metaphorically, are areas that could be hit as those negotiations go through. Where does the oil price get to, potentially, for example? So, yes, these are the traditional hiding places, and they are therefore the ones that have done well as the market has kind of moved through this year. But doesn't necessarily mean that there aren't risks in those areas as well. Now, that's not to say it's all doom and gloom. There are still, therefore, very strong companies with good earnings long term that we think are really interesting from a valuation perspective. They've pulled back and they're very interesting. But unfortunately, it's going to be choppy waters whilst we see that valuation really start to come through for some of those names as well. So it is a really difficult market at the moment.
Yeah, Helen, you point to some of the industrials that are benefiting from long-term trends, AI, data centres. We've talked about these a number of times. I just wonder, are there areas of that when we hear the detail of the tariffs, are there going to be areas that you're going to be watching carefully to see whether you think supply chains might be stressed? Is that going to be a theme that you're going to be sort of running a slide rule over your favourite stocks with that in mind, thinking, our supply chain's going to be in trouble here?
Yeah, no, absolutely. And that's something we've already done. And I think that's what's really important about today is the market has already done quite a lot of that kind of work. You've seen a lot of the names that have got those supply chains that perhaps might be more stretched are the ones that have come down more. You know, the names that have got more of a goods output versus a services output, they are the ones that have come down more. So we've already seen quite a lot of the moves in the market. And what we're actually looking for, therefore, is where almost that absolute worst-case scenario has been priced in, and therefore anything where the negotiations might get a slightly better outcome might be positive from a valuation perspective. Valuations are so important in this market. I think last year we almost saw valuations disappear. You know, particularly in the US, the valuation of stocks got so incredibly high, particularly in Q4, and we've of course seen that reset in Q1. Incredible performance of Europe versus the US in Q1. So we're resetting a lot. We're now back to where the valuations really matter. So absolutely we are doing that. But I think that has already been done a lot by the market, particularly in that industrial space. The dispersion of returns in industrials has been incredibly interesting from an investing perspective. OK,
so the market is already discerning between those industrials that might have stressed supply chains and those that don't. In terms of that repositioning around European stocks broadly, the fiscal boost from Germany, infrastructure, defence, made a lot of people look again at Europe. How far through that story are we, though? Because we talked yesterday to a guest who was saying maybe we're just reducing underweight positions for global investors around Europe. What do you see?
Yeah, no, that's definitely the start of it. Let's not forget how far the US went versus Europe in Q4. I mean, I was here talking about it a lot, and it is kind of almost reassuring to see that that has now kind of levelled back out again. It's actually, if you look at it in US terms, Europe versus the US performance is the best quarter it's been in 3 decades. It's been an incredible quarter in US terms for Europe versus the US. How much further can it go? I think it's got a little bit further to go, and there's a few reasons for that. The first is the flows have started, but they're only really still very minimal versus the flows we saw going in the other direction. And particularly the US dollar weakness, that can really help flows into Europe from the US, for example. So that's number one. Number two, valuation levels are still, the gap was 45%. It's now around 30%. Traditionally, it's around 20%. So valuation-wise, yes, it's levelled out, but there's still a bit further to go. And the third and the most important is it does feel like Europe has started to really kind of come together. The Draghi moment is really, really important. And even if it takes a little bit longer to play out than perhaps we would like, there is still real GDP growth that is attached to what has been announced. And that is really important. The US long-term is still a higher growth, higher returns, higher earnings set of companies. But the gap between the US and Europe is shrinking. And that is super exciting as a European investor.
Is it possible they both just go down, though, for the time being?
I think at the moment, with the level of risk that you are seeing in the market and the likelihood that today maybe just pushes that risk a little bit further out, that we do have a period of volatility in the market.
So what do I do during that period? How do I manage that? I diversify portfolio. That sounds really easy.
Yeah.
And that kind of, I just diversify my portfolio, completely reposition everything. How much risk are people carrying in their portfolio? What do you think the tail risks look like here?
So the tail risks are definitely higher, but the risks in portfolios, on the whole, people have de-risked. I mean, obviously, we saw the big degrossing event a few weeks ago. So, in general, people are de-risking in portfolios. But I think it's so important that that isn't moving out of equities holistically. A de-risking of a portfolio can be taking the positions that you've got, particularly in a very concentrated portfolio, and reallocating around them. You can actually de-risk quite significantly just by doing that kind of growth to value shift within portfolios. And that's what we've seen a lot of portfolio managers doing. Not necessarily the more concentrated, very long-term holders. You don't want to do that too much because of the old adage, when do you go back in? But yes, we are seeing a certain level of de-risking, but that doesn't mean leaving equities.
What about the 60-40?
Well, we are still seeing that positive correlation remaining for a long time. I think we have to rethink what the 60-40 looks like. What are the other elements that you need? Obviously, privates, maybe even a bit of Bitcoin within there. I think we have to rethink 60-40.
So what's in the 40? Gold?
Yeah, absolutely. Gold, maybe a little bit of crypto, although we are seeing positive correlations there. Certainly some privates within it. And who says it has to be 40, Guy?
Yeah.
What does it what
what 50-50?
Well, I wouldn't necessarily take it that far. Let's go back to 60-40 maybe.
Okay. Helen, nice to see you. Thank you very much indeed for stopping by to see you. I've got so many questions. We can keep going all morning. Helen Jewell, EMEA, CIO for Fundamental Equities at BlackRock. Helen was mentioning the Core 6. Let's take a quick look at what it looks like this morning. This is the picture. We are going to see a bumpy, choppy session, I think, probably in front of us. You are seeing some safety bid coming back into the market this morning. As you can see, Nestlé is outperforming on the right-hand side, and Novo Nordisk is underperforming on the left-hand side. The pharma space certainly in focus as we approach this tariff clarity that we're going to get a little bit later on. Joe Easton's got some of the other stocks we're watching. Joe.
So one pharma stock really in focus, Guy, is Grifols over in Madrid. The company back in focus following reports in El Confidencial around Brookfield potentially coming back for the company around takeover talks. It's not quite clear if an offer will come through, but remember Brookfield did previously make an approach for Grifols, the plasma company that's had a short seller attack. So that is the best performing stock we've got on the Stoxx 600 today, up around 8% for Grifols. Then in terms of one pharma stock going the other way, Guy mentioned there, Novo Nordisk. This one is declining now. Hims and Hers in the US. This is the platform, the retailing platform, announcing it's going to start selling Eli Lilly's Zepbound, focusing on the more regular common drugs rather than the cheaper compounders that it previously sold. This has been actually pretty market moving in the past in terms of the headlines on Hims and Hers obesity drugs offering. So competition for Novo is essentially the headline on that, and general pharma weakness feeding through from the US as well, but an interesting mover on that one. Then in terms of autos, still awaiting the big news later, of course, on the tariffs from the US, but Continental guiding yesterday in a call with analysts, known as a pre-close call, around lower volumes and weaker margins. So that is hitting that stock today. We're seeing some weakness on Conti over in Germany on those comments on that one. Then in terms of M&A, a couple of other bits of big news. We've got one from A.P. Moller-Maersk. Potentially their holding company is going to be buying Svitzer. This is a supplier of marine services. Smaller company, actually spun out, I believe, of Maersk not long ago and not had a good run. It's had a bad run since the IPO, but we've got a 30% gain, not too bad for that one on Svitzer. Decent move higher for the company, worth around £1 billion, not the biggest deal, but it is a big mover. Then in terms of the Tesco ready meals, keep getting headlines on this one. Bakkavor, maker of all those sandwiches that we buy on our lunch breaks, that one has got that bid confirmed from Greencore, and actually a little bit better than expected in terms of the offer price. So we're gaining another 6%. That's had a good run for the maker of all those delicious sandwiches and microwave lasagnas as well, they do, I believe. Now, BNP Paribas is the rating change I want to bring you, because we've got Kepler Chevreux, their French rival, downgrading the stock. Analysts at Kepler say that the outlook for them over at BNP is not very ambitious, and they think that the rate of return for BNP is going to start declining. So they go reduce, and that one is declining. BNP stock falling 2.7% over in Paris this morning.
Joe, thank you very much. Joe Easton from our equities team with some individual movers. Coming up, we'll focus on the car sector. An important week for cars, of course. Mercedes considering putting the brakes on some models in the United States in response to what we might hear today on tariffs, or in fact due to the tariffs that have already been imposed on the auto sector and are due to come into effect this week. We'll have details next. This is Bloomberg.
Welcome back to the opening trade. We're 18 minutes into today's session, and risk sentiment is weak this morning, especially when you look at the DAX. That is your underperformer of the morning, down about 0.7%. Paring back, by the way, some of the gains we saw in the European session yesterday. But still, a lot of nervousness ahead of that tariff announcement. Let's go there next, specifically when it comes to the auto sector, because already you're seeing European car makers get very nervous. Mercedes, for example, may withdraw some models from the U.S. as President Trump's tariffs would likely make them economically unfeasible to sell. So what does that actually mean? Bloomberg's Craig Trudell is all over the story. Craig, walk us through it here. I mean, they are the first mover in terms of this. We've already seen some worries around kind of lower costing parts as well. What does Mercedes do in terms of operating in the U.S. if this is their opening salvo?
Yeah, they make an awful lot of SUVs in the U.S. and some for export, which is, something that, of course, Trump wants to see, right? To see U.S. manufacturing, also for the U.S. to export what it makes to the rest of the world. Of course, in this case, these are German badge vehicles, and they don't make, their smallest SUV in the U.S., the GLA. In the U.S., they import those from Germany. And so what our William Wilkes was hearing and reporting yesterday is the idea that the GLA would be an example of a model that Mercedes would look at potentially cutting from the lineup in response to these tariffs. This idea that the tariffs would just render it not worth continuing to sell in the U.S. And I think we may see this be the first of many indications of automakers having a closer look, taking a closer look at their lineup, deciding maybe to just altogether do away with certain models because they will no longer be economically feasible to sell in the U.S. with a 25% tariff.
What happens to the cost of car ownership in the United States after this? What happens if I've got a used car and I need a spare part for it? Is that part going to cost me 20% more, 25% more coming in? Am I going to change the vehicle I want to own because of the price of that? Is insurance costs going to change because of all the factors that tariffs are going to kind of impact onto this market? How much is motoring going to be more expensive in America? And is that something that is going to be material to a lot of people?
Yeah, I think that's a great question. We think about replacing vehicles and buying a new one as being more expensive. But to your question, it's likely that replacement parts will also be more expensive, that will factor into, what is hitting consumers in the wallets. I think it's also, potentially going to have some unintentional or sort of, second-order effects that we don't appreciate. I think one thing that we may actually see is the value of the car that you own going up because people are going to...
So if I own a Mercedes, and is that car going to be worth more money because Mercedes isn't importing cars into the market?
I think we may see that, actually, and some analysts have started to look at used car retailer stocks as maybe one way to play this in the idea that, if people are buying fewer new vehicles, that means less supply into that used market and perhaps firming up of used car prices. That was one of, by the way, the stickiest ways in which price increases of the last few years have stuck around, is that we haven't seen wholesale vehicle prices come down in as dramatic a way as they went up in the wake of the pandemic.
So Americans might hang on to their cars a little bit longer. It all feel a little more European, won't it? Great. What about the imposition of tariffs from multiple directions? Do we have any clue about how auto sectoral tariffs are going to rub up against national or supranational tariffs? So if the EU tariff is, say, 20%, and we already know the auto tariff is 25%, do we add those together? That's a really high number. I mean, what do we understand about that?
I think one of the most incredible things about all this is just the sort of last-second nature of all of it, this idea that the White House is still finalizing these things, hours going up to the deadline. I would be shocked if this was a matter of piling these tariffs on top of one another, because just the 25% tariff alone, that sounds as though I'm minimizing it. That is hugely substantial, especially for parts that go into vehicles, and it's going to affect the entire industry and not just a model here or a model there.
You got to figure out which part comes from where as well when you come to the secondary market as well. That's going to be a huge factor. Craig, great stuff. Thank you very much indeed. Craig Trudell on what's happening in the auto sector. Planes, trains and automobiles all could be affected by this. Let's talk about the planes side of it. Plane makers are certainly watching to see if their industry will get caught up in President Trump's expanding trade war. I went to the heart of the Airbus story in Toulouse to find out why that company may be a little better positioned than maybe its rival Boeing to navigate the expected turbulence ahead.
These giant nacelles
will soon become the key connection between an Airbus aircraft and its jet engines. Supplier Safran makes about 400 of them every year here in France. But since Donald Trump last imposed tariffs on steel, aluminium and aircraft during his first presidency, the company has significantly broadened its geographical footprint.
Our coding centers are next to the final assembly lines, so in China, Tianjin, in Alabama, USA, in Hamburg, Germany, and in Colomiers, Toulouse, France. This way, the final assembly line doesn't have to suffer any burden.
This is the Airbus A321 XLR, the youngest in its family. It has a nose from France, a body from Germany. The wings come from Wales. The rear stabilizer comes from Spain. Avionics come from America. When it comes to engines, you have a choice. You can either go American or French-American. It's up to you. Airbus relies on as many as 18,000 suppliers worldwide who produce roughly 80% of the aircraft. To manage tariffs, the company has the option of using its US factory in Alabama.
We are procuring from everywhere around the world, assembling there in the US with US jobs. To US airlines as well. So I think we are key to the US ecosystem, to the aviation ecosystem, and we think that plays a big role in how tariffs are targeted.
In the end, Faury says that new tariffs may hurt Boeing more than Airbus. The US company uses parts imported from Mexico and Canada and does not manufacture in the EU. It could also lose out in the growing Chinese market. Unintended consequences of the new transatlantic trade war. So it's fascinating. The company has spreadsheets that will basically say, you plug in this number on tariffs, I can tell you what every single contract looks like. This is Airbus trying to figure out exactly what is going to happen here. At the moment, they think they can manage it. They've got a final assembly line in Alabama. They've got them obviously here in Europe. They've got them out in China. Reasonably big geographical footprint. But if things start to get really ugly, it's going to be interesting to see how Airbus and Boeing maybe start to favour clients in certain parts of the world. This is a global business with huge global inputs. But ultimately, at some point, it may get to the stage where you say, you know what, we favour European or Asian customers over US customers. It could get that ugly.
We've seen lots of sectors becoming increasingly regionalised. I've certainly had conversations with pharma bosses in the wake of COVID. That became a thing. Maybe it even applies to aviation.
But these planes are made all over the world. That aircraft that I was talking about there, it is made all over the world. They come together in Toulouse, in Hamburg, in Tijuana, in Alabama, but they're made all over the world. So, I don't know.
Does the math on planes work the same way it does on cars? Something we're going to be keeping an eye on. Next, coming up on the program, we're going to dive into the commodity space. How is it affected by the volatility? That next. This is Bloomberg. Welcome back to the opening trade. About 30 minutes into today's session, you can see risk sentiment is getting worse and worse as we go on. A lot of nervousness around that tariff announcement that we are seeing, or expecting, I should say, at about 9 p.m. UK time, 4 p.m. if you are on the East Coast. But take a look at where a lot of the pain is concentrated. The DAX, which has been the outperformer of the region amid a very broad European rally, that's where you're seeing it get hit the most, down almost 1% relative to, say, we'll call it a 0.5% decline for the French index. Let's talk about some of the individual sectors that are moving underneath the hood. I want to take a quick look at the banking stocks because this is a story, an individual story that I really have my eye on this morning. Banco BPM has been a takeover target for UniCredit for a very long time and is now, UniCredit, by the way, getting some regulatory approval to do it. There are still plenty of hurdles there, but it does take them one step closer to executing that unsolicited offer. At the same time, Credit Agricole also getting the okay from the ECB to raise its 9.9% stake to 19.9%. All in all, what that means is all three stocks are lower on the day. So that's going to be one to keep an eye on in terms of banking consolidation story in Europe. If you're looking for positivity, though, let me show you where it is. It's in the commodities sector, and that's where you are seeing some green on the screen when it comes to that, specifically on the likes of Total and BP. The miners, not so much, but even down 0.1% relative to almost 1% decline on the benchmark is positive news. Why energy is moving higher, though, Guy, that I don't know.
You take me to chemistry. Let's go to the periodic table and figure out what is happening in the commodities market. Citi now sees a 25% US copper import tariff imposed in the second quarter of this year. with us in the studio, Max Layton, Global Head of Commodities Research at Citi. How's that going to work?
Sure. Yeah, so, I mean, we've been recommending clients buy the CME, LME, copper ARB now for a couple of months. And, you know,
wider and wider.
Yeah, wider and wider. We made the recommendation about 6% ARB.
Yep.
It's now around 20 towards the end of the year. It's probably going to be 25. I mean, Trump's already mooted the 25, and it's on the list. So, I mean, I think stepping back from it, the impact of tariffs, whether it's copper or precious metals, even oil to some degree, have been surprisingly bullish so far, right? Physical markets have tightened across precious metals, copper. There's been pre-buying in the US. The scrap markets tighten up dramatically in the US. And China's, stockpiling large dollar-based commodities. So, the big surprise, I think, this year for us has been that tariffs have been super bullish to date.
There must be a point at which you get to where the price is so great in America that it has an economic effect. Copper's pretty fundamentally important to pretty much everything that is happening right now. Do we get substitution? Presumably we do. There must be some of that already starting. Presumably that carries on. How self-limiting will this be?
Sure. I mean, the US is a big consumption market. They're going to keep a lot more scrap at home. That's going to be one of the benefits of this. So the US is a big pool of scrap, aluminium, copper.
And it's set up to manage that scrap, yeah?
Well, not now. But that's with this kind of tariff, with this kind of 25% tariff, the incentive will be there to build out the scrap industry. And, on our numbers, the US can increase its kind of self-sufficiency from about 1/3 in copper to 2/3. Probably within the next 12 to 24 months. It's possible, with this kind of incentive. On the demand side, it's not going to be great, right? The headlines, so far it's been bullish because of the stocking, because of the pre-buying, because of the scrap tightening. But all of that unwinds in the next 3 to 6 months when the tariffs actually happen.
Yeah, so Max, that's the best estimate at the moment, isn't it, of when they will come through, because we don't know what exactly is going to happen on copper. When we do get some news that really takes us, or even today, maybe some of it will apply to some commodities, what should we watch for in the very immediate moment? We were talking to one of our colleagues, Will Kennedy, a few days ago, and he was saying, we could see cargoes of all sorts of things afloat that end up going to different places because tariffs are coming in, especially if they're coming in overnight. Is that something you're going to be watching for in terms of those physical cargoes?
Yeah, sure. I mean, I think a lot of the cargoes, particularly on the copper side, that were on their way in are being moved already. So when Trump mentioned it could be weeks for the copper tariff, that shifted the dynamic, and we immediately downgraded our bullish view on copper to a bearish view. So this physical tightening was a super important bullish driver. It's already unwinding in the last couple of days since Trump's comment. If the tariffs, what are we watching for? I think I'll probably watch 3 countries in particular. Watch the UK tariff. If it's 20, it's probably going to be a bad day off at the office. If it's 20%, if it's 5...
That's as a risk indicator, you mean?
As a risk indicator,
yeah.
If it's 5, that, maybe it's negotiated down to 0 in the market, So
I'm
if you're
interested
going to
you say
look
the UK. Is that just because it's a sense of the risk that Trump is prepared to take here, rather than because the UK plays a big role in commodities? Or...
It's because the relationship on the trade side is a surplus. So, and the UK has a VAT regime of about 20%. So they could be 20 if they include VAT, or it could be low because the UK has a trade surplus. I mean, the other one's South Africa. We think platinum, it's only pricing 5-6% tariff. So if the tariffs are 10 or 20%, and particularly on South Africa, I mean, the South Africa number could be much higher than that. That would be super interesting for the platinum ARB. And then the final one is obviously China. If it's 20 on China, maybe it's going to be a good day. If it's 50, 60% on China, then Trump's going to be following through with his campaign pledge.
Yeah, these are big picture questions.
Big picture questions, but at the core of it is this question of global growth, right? It is that this is ultimately going to be hitting global growth, whichever way you slice and dice it, which brings us to the read-through into oil, because I think it's crucial here that when Donald Trump has been threatening these tariffs, energy infrastructure and even oil prices have largely, even LNG exports have largely been off the table. And I think it scared a lot of people when Canadian energy and Canadian oil was even brought up momentarily. That really moved the markets in a big way. Walk us through what the risk is for oil.
Sure. Yeah, so on the demand side for oil, each 10% incremental effective weighted average tariff, let's call it, for the US is going to reduce oil demand by about 300,000 to 400,000 barrels from what it otherwise would have been. We've already got around a 10% number in our balances, so we've got 900,000 barrels of oil demand growth this year. If it's a 20% number with no retaliation, then we're talking 600,000 barrels of oil demand growth, which, you know, compared to non-OPEC supply growth, even without any US supply growth, is 1 million barrels plus. You can see the potential impact on the oil balances. On the supply side, you know, we are assuming tariffs on Canada don't include significant tariffs on oil and that you don't get supply disruption, in part because President Trump, you know, he doesn't just want lower oil prices publicly. Like, he needs them to at least partially offset the impact of the tariffs on US inflation. So he needs, and we think he's going to persist in his drive to get lower oil prices. And just for example on that, I was just going to say on the Houthi side, I'm not, you know, that isn't about, I don't think that's about getting container ships through the Middle East and into Europe. That's about freeing up the oil in transit in that region.
Yeah, some would argue he's friendlier on some of his Iranian policy and a complete 180 for the exact same reason, getting more supply on the global market. Talk to us about what the floor of that looks like. If Donald Trump wants low oil, how low can oil go?
Yeah, I think there's a lot of support. I mean, the market's coalesced at around 60 being the level at which you see material downside in shale, and also the potential for OPEC plus to reduce their bringing back of barrels and to stop bringing back barrels, essentially. So a soft floor around the 60, 65 level in Brent for those reasons. But of course, you know, if there's 20% tariffs, they're immediate, they're not redistributed. I mean, a super key thing with these tariffs is whether they're redistributed as tax cuts. You know, if that's delayed and you're trying to pay down the government budget deficit instead of redistributing, it's just a big tax on the global economy. Someone pays, doesn't really matter who pays, someone's going to pay, and it's going to be a problem. Of course, if he figures out a way to immediately redistribute the money or very quickly redistribute, it's much less of a problem and much less bearish for the US. It's still bearish ex-US, but it's super interesting.
I was reading lots of tariff cut stories this morning, but they didn't sound imminent. They didn't sound as if they're certainly not coming on the same day. So we're doing one after the other, maybe, in terms of how we get to those stories. I mean, let me ask you about gold. We're at 3,116. I mean, there's a lot of nervousness priced into gold, isn't there, right now? A lot of people buying it because of all that we've been discussing, the uncertainties in the global economy. With that in mind, and the big things we don't know right now, how high does gold go?
Yeah, I mean, we think it's on a path to 3,200 over the next month or two, and 3,500 in our bull case scenario. The bull case scenario is kind of something we model. I would say that a lot of the gold models over the last 3 or 4 years, they've broken down. The real rates, currency, I mean, they're correlations more than models. These correlations have broken down. And so we've created this framework for gold pricing where you focus on total physical investment as a share of mine supply. Currently, the market, like investors and central banks, are buying 90% of the mine supply. I mean, you know, 20 years ago, it was 0% back in the 90s, or 25 years ago back in the 90s. It's gone, it was almost 100% 2009, 2010, and we're basically headed there over the next quarter. So it's central banks, ultra-high net worth, and just in the last couple of months, the US household looks like it's starting to buy the ETF because they're worried about US growth. Now, when you've got all of the mine supply being mopped up, you're basically trying to switch off jewelry. And you were asking me before the show about the jewelry response function. Yeah, jewelry response function is surprisingly resilient. It's all about China income, India income, and income growth globally.
Because gold's a very easy thing to sell in a recession. And that's what we've seen in past recessions. Everybody goes, it's a great growth hedge. But in reality, the first thing people sell is often their gold holdings because it's fungible, it's easy to get rid of.
That's right. I mean, so gold rallies into recessions, then, you know, at the immediacy, when people realise, say, for example, late third quarter 2009, fourth quarter 2009, gold is flat to down, actually, in that short window. And then as, say, the Fed steps in to back things up, you know, dramatic drop in real rates, it tends to rally a lot just coming out of the initial part of the recession. The developed markets, wealthy people tend to buy a lot of gold at that point. And the emerging markets tend to have a big stimulus, so it's downward pressure on the dollar, you know, rebounding jewelry demand in China and India, for example. So, yeah, so I think it rallies into it. It outperforms by being flat versus everything else in the actual recession. And then initially it rallies out of the recession, and then you probably get out.
Okay, then you get out.
And then you get out.
There is a moment you get out, I'm sure, at some point.
Yep.
Max, great to see you. Thank you very much indeed. Max Layton, Global Head of Commodities Research, joining us from Citi. Coming up, Trump's so-called reciprocal tariffs are just hours away. 4 p.m. in the Rose Garden is when we're going to find out. Next, we're going to speak to the former head of international affairs at the US Chamber of Commerce. Myron Brilliant is going to be joining us. That's next. This is Bloomberg.
Welcome back. This is the opening trade, 45 minutes into our programme this Wednesday, the 2nd of April. We're going to get further details on tariffs, of course, later on. And there might have been a temptation to think we'd be in some kind of holding pattern going into that, but we are not. Risk off once again. Risk off for European equities. US futures pointing lower as well. E-minis down by 0.3%. Let's talk about where this all leaves global business. China is touting trade benefits for the United States in what appears to be an attempt to cool tensions ahead of President Trump's so-called reciprocal tariffs. The Communist Party official newspaper highlighted US farmers and tech companies as beneficiaries. Let's bring in Myron Brilliant, former head of international affairs at the US Chamber of Commerce. He's now senior counsellor at DGA Albright Stonebridge Group. Myron, nice to speak to you. Thank you very much for coming in. So a lot of pre-positioning, countries trying to get their narrative straight, I suppose, as we go into this. There's a lot we don't know. I know that you're working with businesses of all kinds to prepare. How is business preparing? How can business prepare to such an unknown quantity?
Well, I think business has to be nimble, right? It has to be flexible. There's a lot of uncertainty. There is certainty in what the president is doing, though. He talked about it during the campaign. It was embodied in the America First trade policy. He wants to project strength. He wants to project confidence in the American market. The problem is it's not Liberation Day for most Americans, right? Consumer prices might be higher. Small businesses might feel the heat of higher inputs into their businesses. Certainly farmers are going to see retaliation from the Europeans and elsewhere. Market is volatile. Market investors are nervous. Companies are going to hold on to capital. And, of course, I don't think it's Liberation Day in Europe or in Canada who are going to feel a lot of heat from these tariffs.
Yeah, a lot of politics in that word, so we'll perhaps leave it to the side. What about the Chinese response then? You were talking about the response there we might get from Europe on farm goods and from China perhaps. I know that you've been in China not so long ago, and I wonder what you're taking away from that, your instinct as to what the Chinese response is going to be.
So I was in Beijing a few weeks ago, and I wrote a piece afterwards suggesting that this is a window of opportunity between President Trump and President Xi Jinping to get a deal done. Xi Jinping has certainly put on the charm offensive with American business investors, did it at CDF, Chinese leadership, as well as another forum. The problem is, as you start stacking up tariffs, right? We've gone to 10% to 20%. Obviously, now we see more tariffs coming on board. It creates a difficult environment for trade negotiations for the Chinese. They can't look weak in the face of opposition from the United States. On the other hand, we're talking about the two biggest economies in the world, right? So stabilization for China is important. They have a weaker domestic economy. The United States has still a huge trading relationship with China. So we've got to figure this out. But the window is narrowing. At some point, the escalation rises, and the pressures both in China and the United States make the environment for getting a deal very difficult.
So what's the impulse with the folks that you're working with the corporations, with the companies that you're working with? Is there still that desire to go out and grow internationally that there was, say, 10 years ago?
Well, look, I deal with association leaders across the United States. I deal with corporate executives that I've talked to before I went to Europe. And I think, look, they see the opportunity for investment. Certainly, the United States is talking about more deregulation, energy strength, projecting a tax extension that would be beneficial to our domestic economy. But it's being blurred by the tariff pressure, right? And the market disruptions and the retaliation and the supply chain challenges. So I think companies are going to hold on capital if we don't see a clear sign where this is all leading to. And fortunately, I don't think this is the last act, right? Today, what we're going to see in the Rose Garden in a few hours doesn't suggest the final act. The president has decided in a course of action that is more than just short-term deal-making, right? The bottom line is he sees revenue growth from the tariff imposition. He sees an opportunity to deal with retribution of unfair trade practices, the 15 countries he's identified in particular. And so that makes it very difficult for U.S. Corporate leaders to decide where to place their investments and their bets, because we're going to see retaliation, and we don't know where that's going either.
What is that green light, though? If there is this nervousness, if there is this concern around not just what comes out of D.C., but what comes out of everyone else in terms of response, what is the green light for folks to say, actually, okay, we have a clear idea, as Guy likes to call it, Clarity Day, not Liberation Day. We have a clear idea of what the next couple of years are going to look like.
Why do we have a clear idea? I don't think we do yet. I think what we're.
Well, what would that look like? What does clarity look like?
A clear idea is certainly that we see where this is all leading on the tariff front, and we start moving to what I consider the growth and innovation agenda, right? Tax, deregulation, energy investment, right? That's where we're going to see growth in the U.S. economy, and that's where we're going to attract investment. For U.S. companies looking to do business overseas, the world market is much bigger than the United States, right? They want to continue to place bets on economies that are growing, whether it's in Vietnam or Mexico or other parts of Southeast Asia, or certainly, obviously, here in Europe, where we have a huge transatlantic relationship.
Yeah.
But I think what we don't know is how Europe will respond. Europe could respond through retaliation, but maybe Europe says, hey, we need to do a better job deregulating our own economy and creating opportunities for not just European companies, for those who want to invest here. So there's a lot still to unpack. And I think uncertainty is certainly going to be a term you hear a lot.
Does the WTO survive this?
Well, the global trading system is fragile right now, right? Fragmentation is the call in order.
Yep.
I don't think that's in the long-term interest of the United States or Europe. I've been a free trader all my life.
Yep.
I think we have to move away from that term. I think we have to talk about fairness in the trading system.
What does that new system
look like?
But the
WTO system has not responded to the challenges that the United States has been talking about, right? It's not adapted to the new realities of subsidization in the marketplace, excess capacity, has not addressed some of the systemic challenges that we now see in the global trading system.
Does it change or does it break?
Well, I think we're at a tipping point. It could break. And
what does breaking look like?
Breaking looks like a lot of regional blocks. Breaking looks like a lot of unilateralism, self-reliance policies that take us away from building a global trading architecture that the United States and Europe started.
There's a narrative, and you kind of hinted at it, that tariffs are going to be okay and digestible for the American public if tax cuts come right on their heels. How viable is that?
Well, the tax, process is going to take time. It's not going to be done right away. It's going to take several months to get through the Congress. I think it's, in the end of the day, is going to be a boost to the U.S. economy. It's going to spur growth. It's really, frankly, doubling down on what's already been in the system, but you've got to pay for it.
Does it
and
offset
that's the big challenge.
Does it offset the impact of tariffs? Do you see them counteract domestically?
Well, first of all, I don't know what the final resolution will be on tariffs, right? We assume that it'll be a 20% reciprocal tariff rate across the board, but it could be something else. How much of the statutory authority is going to be through IEEPA? Is it going to be through some other measure? Is there going to be a 301 process? We still have to see what the final deal is here. Yeah. But what I can tell you is that I don't buy what Peter Navarro was saying in the White House, which is it's going to stimulate $600 to $700 million of revenue to the U.S. economy. I think most economists think the number is much lower. And there is still the trickery of how you offset the deficit we have, the budget deficit, which is something in the order of $4.5 trillion. So there's a lot to work through the system.
Absolutely.
There's still optimism. If you talk to executives across the United States, there's still optimism.
Yeah.
But there's more work to be done.
Lots to look forward to this summer. Myron Brilliant, we thank you so much for joining the program. The former head of international affairs at the U.S. Chamber of Commerce. Let's talk about the market reaction here. How are people bracing for what's coming up? Bloomberg's Valerie Tetel is around the table. All right, Valerie, walk us through the worst case scenario.
Look, we've gotten a few leaks to the market about a few numbers, one of which being 20% thrown out. So I think the market is really going to focus on what is the highest number that Trump's talked about. If it's above 20%, I think we could see a downside surprise to the equity market. If it's something lower than that and there's numbers of 10% mixed in, there could be a sigh of relief when it comes to risk assets. Maybe we see an equity market rally if there's a number like 10% on the table.
We've got the announcement coming at what was supposed to be 3 yesterday. It's 4 now, and it's getting quite close to the end of the US trading day. I mean, that sounds a bit congested.
Oh, it was interesting that they did move it a bit later. Perhaps they want these announcements to come after the cash equity close. We'll still have futures trading. We'll still have Treasury futures trading. Obviously, FX might be the most liquid market at the moment, but I don't think the trade is going to be in FX. I'm really interested to see how the Treasury curve reacts to this. If perhaps we get a number higher than 20%, I want to know if a Treasury rally is led by the front end. Like, is the market going to assume that the Fed is going to be there to protect growth with a cut sooner than expected? Or is it going to be led by the long end, maybe the belly, maybe the 30-year, and just the market pricing in a downside hit to growth, maybe without the Fed being there, without the Fed put being there at all. The other things that we should mention is there is a big skew, at least in Treasury options, to calls, meaning that the market at the moment is more concerned about a large Treasury rally than we are on some backup in yields, on some worry about inflation. So the growth impulse is way more of a concern for the market right now, rather than the inflation impulse, which perhaps could come later down the line.
In 30 seconds, the ISM, the inventory number was high. Does that imply that US manufacturing has a buffer?
Look, there seemed to be a glut of manufacturing showing in that ISM number. But what I thought was interesting was prices paid ticked up very high. But market did not react to that. Treasury market rallied based on the fact we got a lower than expected number. And I think that's the key takeaway headed into the tariff announcement later.
Growth fears front and centre. Valerie, thank you very much indeed. We've got a lot of things coming up. Obviously, this time tomorrow, we're going to be working our way through what this tariff story is going to look like. The pharma sector could be absolutely front and centre. So the CEO of Nova Holdings is going to be joining the pulse. That conversation is coming up at 9:30. We'll get a take on what exactly could be coming down the pike towards that sector as a result. That conversation is going to be interesting. I think everybody's just in speculation mode as we work our way through today and into tomorrow morning. Yeah,
and we speculate and watch risk assets go lower. US futures a little bit weaker this morning. European stocks are weaker. That is it for opening trade. The Pulse is next. This is Bloomberg.